So Rick has a question here. We are going to talk about Bull Call Debit Spreads for a little bit. He's got a couple questions, a question or two here related to Bull Call Debit Spreads. And I'm going to read part one and address part one, Rick. Then we're going to address part two. So Rick says, any value, success rates, or history in your experience in buying Bull Call Debit Spreads in the money, longer term, closing them early, versus shorter time frame, 30 days, pros and cons. Okay, so let's take a look. What is he talking about? Well, there's multiple ways to trade Bull Call Debit Spreads. And what is a Bull Call Debit Spread? Well, that's where we're going to enter into a leveraged bullish spread position. We're going to sell a call, usually for Rick's evaluation, in the money. So let's say we had a stock trading at 90. I might be selling an 80 strike call deep in the money and then buying a 75. So I might get $1.50 here. I'm sorry, it's in the money. My apologies. We might get $11.50, let's say, for this 80 strike call. And we're going to pay maybe $15.85 here for this position. So what does that mean? We're going to pay $15.85 and sell at $11.50. That might be exaggerated. We're going to take a look at a real example in a moment, Rick. But in any case, we're going to pay a debit to get into this position. Now, as you can see, if the stock falls below 75, what happens? Both calls expire worthless. We lose the entire net debit that we paid into the position. We have 100% at risk of what we invested in the position, which is the debit. We can lose all of that. It's a leverage position. The lie of leverage works both ways. If the stock stays above 80, what happens? Well, we entered an obligation by selling the 80 strike call to deliver shares of stock we don't own. But we also bought the 75 call, which gives us the right to buy shares of stock at 75 to cover our obligation at 80. So we'll get 5 points back. The maximum profit is going to be that difference in strike price minus that initial net debit. And then the return is that profit divided by the net debit. Now, I mentioned there's multiple ways to trade it, just like anything else. You can do weeklies. You can go 30 days out in time. You can go 60 to 90 days out in time or more. I have investors that trade 1 year out Bull Call Debit Spreads. They're not really in the money, however. Most of the investors I talk to, power options users I talk to that use that far out in time method, some are going deep in the money, sure. Not a lot, but some are going deep in the money. Others are using sort of a just at or slightly out of the money position, meaning if our stock was at 90, they might be selling the 92.50 call or the 95 call and buying, say, the 87.50 or the 85. So in a sense, they're still in a Bull Call Debit Spread, of course. But instead of the stock price being up here where they were deep in the money for extra protection and higher probability, the stock price is maybe here or here. So they're using an at or just out of the money position. And we're going to define that a little bit more in just a few moments. But that's the Bull Call Debit Spread in a nutshell. You've entered an obligation to deliver shares of stock you don't own. You bought a deeper in the money call that gives you the right to buy those shares of stock. You don't have to put up any margin. You just pay a debit to get in, and the debit is the risk. Is there a measure of success? Well, yes. Many webinars that you've heard me talk on, or if you haven't heard me talk on yet, one of my favorite approaches, which represents about 10 to 15%, sometimes more, it's been recently 15 to 20%. We're going to scale that back. Now we're seeing the bearish sell warnings. As I've been doing deep out of the money bull put credit spreads that are usually 11 to 10 days out of time. So on Monday, I'm not going to run the search on this Monday, by the way, with the sell warnings, but on a normal Monday, I'd run this search, pick out the position I want. I'm targeting sort of around a 15% return with an 87% probability. Since, I've been developing this criteria, work with this criteria, this is my preferred criteria. This is exactly what I use, by the way. It's the weekly bull puts default theme search that we created essentially after testing and actual trading. And what I found historically is that almost every year, pretty much very well, but there's sometimes when I'm not entering positions, Rick, as I mentioned, when I'm seeing the bearish sell warnings, but we achieve roughly around a 14.9% average return with an 86% success rate on the positions, but we are using stops. So those other 14% that we might lose on, we're only allowing ourselves to lose 50% of the maximum risk. In other words, 50% of the debit you would have paid. This in the money, shorter term bull put credit spread would be a parity trade to the in the money bull call debit spread at the same strikes. So what I'm telling you is that I have seen great success with this shorter term. Longer term, 30 days out, I mean, Rick, my apologies. Longer term bull put credit spreads, I still had some success with, but for a compounding nature, I found the 2 weeks out more profitable for me, even more profitable than going week by week for whatever reason. There's a couple of reasons there, but that's not your question, so I don't want to go in that rabbit hole. Caterpillar is very familiar. So let's just take a look at this. My in the money, high probability bull put credit spread would be to sell the 26th of July 317.50 put for 88 cents at midpoint. Well, I'd be targeting the midpoint price. We'll talk about that too just a moment. The stock's at 335.59. So we're a good 18 points in the money. And to hedge the loss there, we're going to buy the July 26th 315 put. And at midpoint, we're going to target a net credit of 36 cents. On a 2.5 point spread, that means the most I can lose is 214. Well, this would be a 16.8% return against the true risk, with almost an 88% theoretical probability that Caterpillar will stay above 317.50 in the next 14 days. Now, what I expect to see, we're going to go to the profit and loss chart, and we're going to substitute our bull puts after we take a quick look at the chart for the bull call debit. And I expect the bull call debit in the money now, because it's the calls, should have a debit of around 214, 215, 216 with a return of around 16.5, 17%, and would still have the same 87.9%, 88% theoretical probability. So let's go to the profit and loss chart. Let's take a look. 16.8% return, 36 cent net credit against a 2.5 point spread. So the maximum loss, remember, we would take this credit up front, Rick. So even though I'm putting up 250 for the trade, the most I could lose, even if it went completely against me and Caterpillar dropped below 315, would be $214 per contract. Now, let's clear it out. 317.50, 315, but on the call side for July 26th, which are going to be 18 points in the money on the sell side, and on the buy side, of course, the 315. Remember our numbers, 214 at risk, max profit of 36, 16.8% return, and we're at roughly that's 89% probability. So we're going to sell that call 317.50, buy the lower strike 315 for a debit. Oh, it's a little bit higher at midpoint. So the debit here is at 228 roughly. The max profit is $22, $23, so it's only a 9.9% return. Now, this is one caveat that does occur, Rick, that I know you're familiar with. With the deeper in-the-money options, calls, or if you're doing bear put debit spreads, where you'd be buying in-the-money puts instead of a bear call credit spread, if you do parity trades, as you go deeper in the money, you start to see wider bid-ask spreads. And that's why it's naturally harder to get sometimes a better fill price compared to the bull puts, which might only have a 5 or 10% or 5 or 10 cent bid-ask spread with the deep out of the money put options. Let's take a look at that one more time very quickly. This is not to dissuade you, but I just wanted to show this. So here, yeah, we're looking at a bid-ask of 88 to 115. So getting a midpoint around 95 or maybe even $1, $2, I think is feasible. A 3-point bid-ask spread here, I'd like to get closer to the midpoint, but I have a feeling the market maker is going to push me more to this bid with this deeper in the money call. And he's going to push me closer to the ask with that in the money call. But, you know, I'd like to get around 2140, 2145 buy price, but he might force me closer to 2180 or 22 because it's got a wider bid-ask spread. He's got more room to play with. With the out of the money puts, of course, we're talking nickels and dimes, so it's a little bit closer monetarily. All that being said, these two are parity trades, Rick, of one another. So what I would expect over the same time horizon I was talking about, the last several years of running different tests to develop the criteria I want and then trading this, entering it when we're in the buy to neutral or strong buy signals on the market sentiment tool, and avoiding it when we're in the strong bearish sell ones, I'd expect to have the same rate of return. 86.5, 87% success rate. Hopefully getting an average of around that 14, 15% I mentioned, but it's harder when you got to haggle with the prices for the wider bid-ask spreads as well. And of course, limiting the risk to 50% to stay in the game. I'm going to try to visit that a little bit later, but I won't go too far off on you. Now, with the in-the-money spreads, I'd expect to see the same thing longer term. In other words, if I opened a 30 to 60 day out Bull Call Debit Spread and I targeted that 80% rate or higher, I'd still expect to get that on a regular basis. So here's ones here, but they're looking about 70, 72, 73. Let's bump that probability up here in the Bull Call Debit Spread search to be above 75. We're going to avoid earnings between now and expiration. We're going to look for stocks in an uptrend. I might even look for a positive MACD signal because that's what I like to use. We're going to set a minimum return of 10%. All right, so I have some more volatile ones that came up. GameStop, I don't know if I do. Canadian Solar, Chewy, that's been in the news recently with that, Reddit guy and everything, Roaring Kitty. Iris Energy is pretty good. Semtech is pretty good. Marvel Tech Group's pretty good. Now, these are showing a much higher return. In this case, we're out 35 days. We're getting a lower net debit. We still have a 75% probability. And you're seeing some that have really high returns, but that's not due to the bid-ask spread. These are actually very close, much closer than what we saw in that first one. Time horizon wise, let's go ahead and save this. And I want to call it Bull Call Test 30 from July 12th. Okay, simply going to save that search. Now, before we do anything else, just open up another Power Options window here. All right, there we go. And just want to look at something. I mean, I know the market. I know where we've been having some issues recently. Not issues, I should say, but in this year. But I want to go back. I want to take a look at SPY real quick. All right. So what I want to target here, Rick, do I have the ability to do this? Yes, I do. I want to go from roughly around May 7th or so to June 11th. All right. So what am I looking at here? What I'm looking at here is, hey, we've got some bullish run here. We had a pullback here, and then we went back to a bullish run. So I just want to see, and we could go back further. We could go back here into April and run this scenario and this. I'll do more of a full analysis later when we have the time. But I just want to go to May 5th or May 7th right now. So here's what we're going to do. We're going to go back. We're going to clear out the drawings. We're going to go back to Power Options. We're going to go Bull Call Debit. This is a trial account. But on the trial account, you have about 90 days access, I believe, to the backtesting tool. So we're going to go into Smart History. We're going to go Bull Call Debit Spread. I'm going to go back to May. I can only go back to the 13th. All right, so we're going to have to use the 13th. And we're going to do our Bull Call Test 30. Now, what this is going to do, it's going to run back through our historical data, of course. It's only based on end-of-day data. And it's going to tell us which ones would have matched this default criteria on May 13th, 2024. Now, I apologize. This always happens on the Friday. It always happens in the afternoons. Right now, the system is updating all of the tables of all the end-of-day data from today's close. So you got a bunch of tables getting data filled into it, and we're picking those tables, say, hey, find me the information I want, but it's taking a little bit longer than it normally does. So I apologize for that, but it'll pop up in a moment. And then what I want to do, this is just the 30-day out, remember. I just want to see an evaluation. So we should be opening positions on May 13th. It should be for the June expiration, June 21st. So we would have crossed over that June 11th threshold and gone back up into the uptrend. I've got Snap, I've got Toast. I want a higher price. We got Google, of course. Oscar Health. Ooh, why not take? That was more recent though, wasn't it? But let's do two. Let's do Alphabet. It's there. It's Google. We all know it. We all love it. One way or the other. I'm not trading it right now. And I just want to go to Analyze Position. Now, I'm also going to go back, Rick, and calculate the group results. In fact, I'll try to do that. Oh, okay, this came up. So the max return, well, this is due to a wide bid-ask spread, obviously. But in 621, the max return was 26.6%. The max loss was 16.5%, and that was just a few days before expiration on 618. But you didn't hit the 50% close. Okay, you were at a 16% loss on the position. Okay, this is what I wanted. On the 18th, the stock price was at 175.09, and we had sold the 150, so we're still golden here, okay? So this position wouldn't have been closed. This is an aberration of wide bid-ask spreads at the close, and you would have made the max profit on the position if you got the good fill prices, but that's something that would have worked. I want to do the same thing. I want to take a look at Oscar Health. Again, stock's at 21.95, 19 strike to the 18 strike, a 1-point spread, debit of 80 cents, so 25% return, and we had a 76.3% probability. Let me analyze that position. And the max return was, pretty close, but this one lost 92%. And it's because Oscar Health had some bad news. Now, I thought on our search, I'll check that in a moment, but I thought on our search we were avoiding stocks that had an earnings between now and expiration. But that's essentially what happened with Oscar Health. But it got some bad news, and it just continued. You can see that here. It just continued to plummet during this time frame. So, hey, you made the 26.6% on one, and we lost essentially the full amounts on the other one. Now, that's one snapshot in the market, but you saw what the market did during that time. Of these top 30 results, let's see how the group of that did 30-day out trades, 75% probability or higher, over the time frame of May 13th. We had to use, remember, to June 11th. Now, there we go. So we got one big loss, one minimal loss, one average loss, a bunch of average gains. Success rate of about 85%, and the average return came out to be about 8.5%. Okay, and at the same time, QQQ was up 7.7%, and SPX was up 4.5%. Okay, so statistically, that's what I expected to see. That's what I do expect to see with those kind of success rates, with the preferably going 80-85% probability. And of course, we went over a time frame where we had a good up, we had some downs, some positions clogged out, that full loss on Oscar, for example. But with the right strength and the right probabilities, that's what we saw during this time frame. Okay? Now, if we went back here, went back further, that would be a little bit different. But again, Rick, looking for the same criteria, 30 days out, even 60 days out, although the market tends to change more drastically, I expect to see the same results that I've gotten with the preferred 2-week out bull put credit spreads. Okay, because that's what we expect to do. But you got to control the losses to that 50%. That is key, because if you don't, you'll get wiped out. I'm going to mark myself here to show you why I keep hemming and hawing on that. We're going to use the trade simulator tool. Okay, now we're still in the first part of your question. I understand, but you gave me this part in this question that says buying call spreads in the money longer term and closing them early versus shorter time frames, say 30 days, pros and cons. We've actually done a few webinars on this with bull put credit spreads, which would come out to be the same. There's multiple ways to trade these. And a gentleman came and said, Mike, I was reading something and someone was talking about doing bull put credit spreads where they go 30 to 45 days out in time, targeting almost a 25 to 30% return with a 75% probability, but closing the position early if they get half of the expected return. Okay, and so I said to myself, okay, I get what you're asking. That's a great question. You always want to do comparisons and you always want to ask comparisons. But if I've got an 85% success rate, averaging 14.9% return with an 11 to 14 day out time period and an 87% probability, why not make less work for myself, do this, have most of the options expire worthless, and only have to maybe manage or adjust 10 or 15% of them, rather than opening all the trades I would open 28 to 30 days out in time, targeting a 30 or 28% return, but making the extra step to close them in 11 or 14 days. The idea of that approach is that if you get to further out in time, let's go initial values. This is bull put still, mind you, but it's still the same profit and loss chart. So we're just going to take Adobe here for this particular bull put. Yeah, so it's almost a 25, 26% return, double of what I'm looking for. We're 35 days out in time instead of 14. We're making a perfect example. We're making a net credit at midpoint of $1 on a 4-point risk. There's our 25% return. So the idea is if in the first 14 days, 10 days, 12 days, I get the time decay that I want, and I can close this position and make 50 cents on a 4-point risk and have a 12.5% gain, what should happen? Well, instead of my expected 85% success rate with the 2-week out trades, I should be able to increase this to more than 92, 95, maybe a 98% success rate by closing early and taking half the profit. And my experience has been this is not the case at all. When the position goes against you, as it would for me in my 14-day out bull put credit spread, it would go against you before you hit the 50% mark. You're still going to be around 85, 86, 87% success rate, but you're still taking a 12.5% return with the same success rate and doing the extra step to close it. That has been my experience. It did not increase the success rate because most of the positions I've found doing that, going 30 days or 40 or 60 days out in time, if you're in a market like we've been for the last 2 months, maybe since June, or 1 month really, since June 11th when we saw that last dip and then it started to come back up and we were just going up, up, up to a little hiccup recently and now we're seeing the sell warnings, you might have had a 95% success rate by doing this. I had almost a 94% success rate with the bull puts exceeding expectations because the market was strong. I'm not taking the extra step to close them early. I'm letting most of those expire worthless and only have to manage 1 or 2. That's been my experience. So pros and cons wise, do you want to take the extra step to get into the position knowing that you want to close it early versus just going 14 or 30 days out in time, still having about the same success rate without the extra management, still having about the same return rate, and still having the same at risk? That's what we came down to. Those were my thoughts on those different presentations that we did. One of those very quickly can be seen here. Let's go to the YouTube channel very quickly. And I want to go to playlist. There we go. And I'm pretty sure it's in my bull put playlist. Yeah, let's go in the bull put credit spreads, strategies, tools, and more. There's also one for bull call debit spreads. 2 ways to trade a strategy, bull put credit spreads. That's where we made that discussion about going 30 days out in time with a similar probability and closing early versus just doing 1 to 2 week out trades, only closing the ones that go against you, letting the others expire worthless. Okay, that has been my experience. And also, I don't have one for this yet. I might put this part of the discussion in there. Let me go back one, Rick, and our discussion on bull call debit spreads, the full playlist here. In the money versus out of the money bull call debits, bull call debit or bull put credit, stops on debit spreads, 7 ways to manage a debit spread, and so on. So you've got some great information here on the debit spreads, our thoughts on ITM versus OTM, and credit versus debit, and the stops that we prefer to use on our debit spreads.